How do penny stocks or microcap stocks beat the market?
So I'll start with the makeup of the portfolio.
Today we're joined by Adam Wilk, founder and portfolio manager at Greystone Capital.
Primary research is a big differentiator for Greystone. I spend a lot of time doing it, and I think it provides an opportunity to really go deep on our companies.
Since launching the firm, Adam has achieved a 24.3% CAGR by focusing on overlooked small and microcap companies.
Whether you're looking at a 30 million or 50 million market cap company or a 500 million market cap company, there's an opportunity to find really quality businesses run by quality people.
His approach is concentrated, research-driven, and patient.
I consider myself market cap agnostic and company agnostic, and I'm really just looking for the best opportunities.
In our conversation, we'll cover how he finds opportunities others miss, what most investors get wrong about small caps, and how he manages volatility in such a concentrated portfolio.
What I'm looking for comes in many shapes and forms, but I've really put an emphasis on.
I'm so honored to announce that our main sponsor is microcapclub.com. When I first joined the club, I realized I had just entered one of the most unique investor communities in the world. It's a private network of 270 of the best microcap stock pickers globally. Since 2011, members have profiled more than 1,300 companies, and over 300 of those have gone on to become multi-baggers. That's the power of this group. It's where ideas surface long before institutions ever notice them. And if you're obsessed with finding great businesses early, there's no better place to be. Surround yourself with some of the best investors in the world by visiting microcapclub.com and applying to join the club. That's microcapclub.com. Your firm has outperformed the Russell 2000 and the S&P as well. So to be blunt, how do penny stocks or microcap stocks beat the market?
Sure. So I think that's a multi-pronged answer, starting with the construction of the Russell 2000, which I think represents largely small cap companies in the US, but is probably a poor representation of getting small cap exposure. And what I mean by that is a large portion of the Russell is made up of unprofitable companies. A large portion of the Russell is made up of companies in the healthcare and financial space. And the types of companies that can compound value for years into the future are not necessarily included in the index. They're either maybe too large, or again, the index construction doesn't allow for it. So in my view, it's been somewhat of an easy opponent or competitor, so to speak. I think if you're actively managing a portfolio of small caps or micro caps, it's, I don't want to say easy, but it's a little bit easier to find good businesses run by quality management teams and build a portfolio concentrated into those investments. And that's largely what I've tried to do since inception. I run a concentrated portfolio, and I'm really trying to identify quality businesses with quality management teams that can compound their value well into the future, and getting very familiar with the companies, doing a lot of primary research, and really understanding what is going to drive value has been really key to that success. And I think measured against what's included in the Russell or even the Russell Microcap Index, there's an opportunity to, again, craft a portfolio of more higher quality companies. Now, you use the term penny stocks, which I kind of resent a little bit. I don't think anything in the portfolio resembles the typical definition of a penny stock. And there's even, I think microcaps should have graduated by now from having a sort of penny stock status or narrative surrounding them as low quality companies or sort of sleazy companies that are being promoted or even companies that are trading, let's say, below $1 per share. Hopefully the current market environment has kind of eliminated that narrative. But in the microcap space, whether there's a company, whether you're looking at a 30 million or 50 million market cap company or a 500 million market cap company, there's an opportunity to find really quality businesses run by quality people. And so if that is still the narrative that, you know, all microcaps are penny stocks or all microcaps are less than quality companies, I think that in and of itself provides an opportunity as well to kind of sift through as an active manager and find businesses that don't fit that moniker and that, again, can compound their value well into the future. So again, really the strategy has been to find a select group of quality businesses, and those may start out as small companies, but ones that can grow into much larger ones, and try to back really good management teams and then adopt kind of a value-based framework in terms of the price we're paying for these businesses and what we get out of them.
Understood. And so what are people missing? What are these people that think like all microcaps are penny stocks, or they are companies that are trying to promote themselves and like pump and dump? What are they missing about the fundamental process of microcap investing, so to speak?
I think instead of focusing on what people are missing, I think the sort of better conversation to have would be, or a better way to answer that question would be surrounding the sort of institutional limitations on owning smaller publicly traded companies. You know, I'm actually amazed in today's market environment. I was just thinking about this earlier today, actually. The playing field has been leveled in a very significant way with the use of technology over the last decade or two. And the average investor or retail investor, individual investor has access to an amount of data and a number of companies and write-ups and blogs, et cetera, that were not existent a decade plus ago. And so I'm always amazed whenever I find a microcap that I think is interesting or undervalued. I will maybe Google it with the word Substack in it, or I'll check Value Investors Club or one of the online forums. And a lot of times there will be a write-up or multiple write-ups on that business already, even if it's a $30 million, $50 million market cap. And so that has shown me that there are people outside of the sort of institutional framework looking at these businesses. And it's very hard to find a truly undiscovered company that nobody has looked at, where there are no write-ups or no coverage. And so that part of the game in terms of fishing in the microcap pond has been very interesting to me. I think there are now much more eyeballs on these companies than there were in the past. And the idea that microcaps are underfollowed or overlooked is still true to an extent, which I'll get into. But mostly, I think people are very aware of the fact that inefficiencies can exist in the smaller market cap ranges. That is because there are less professional eyeballs and institutional eyeballs on these companies. And I think microcaps in general, despite the fact that they may have been written up before or looked at by retail investors, come with sort of an embedded discount in the shares because there's just not a lot for two reasons, I think. One is, again, there are less eyeballs on them. Larger funds managing $500 million or $1 billion and above can't really get involved with a $100 million market cap business or a 250 million market cap business. It's too illiquid. It's too small. So that's one reason. But the other reason is that the information flow for smaller companies is just much smaller than for a liquid large cap business. You know, I could spend the next 2 weeks reading everything I could on Uber, for example, and there would be no shortage of write-ups and sell-side research and blog posts and information and company-related things that would allow me to get familiar with that business and the opportunity and maybe see what's priced in to the shares in terms of the current valuation. But in microcaps, a lot of times I come across companies that don't have any sell-side research and no analyst coverage. There's maybe 1 or 2 write-ups on them that are, buried in someone's blog or somewhere that's difficult to find. There's no real information about the business segments or the unit economics, maybe just a little bit in the filings. And so it requires a little bit more work. And again, the reason why a larger fund may not be willing to entertain going through that process or doing that work is because owning a small company in a large fund doesn't really move the needle for an active manager. And so just by sheer virtue of size and the fact that they can't get involved, kind of an institutional constraint or size constraint, means that they may just put a really good company aside. And, if you find a microcap that's small and can grow into a larger business, let's say you find $100 million market cap that grows into $1 billion market cap, that's the point at which many institutions can get involved and many large funds can get involved. And then you kind of experience the liquidity effect and the discovery effect of a larger company that's kind of becoming a small cap. But this doesn't always happen this way, but my aim is to try to take advantage of that initial period where I can invest as a smaller fund in a smaller company and kind of let it grow into a larger one. So I don't always start my search in the smaller market cap range, but when I do, it can be fruitful. And again, the idea is that I think just pure size constraints and the fact that there's less information about these businesses makes it a very interesting place to look. It's not so much what people are missing, but just more the constraints around the companies of this size.
Got it. And I think you describe it perfectly. This is the
like the reason why I love this space, because it's really hard to find, as you mentioned, like a large cap that no one has ever even written something about on Twitter or anything like that. And sometimes I'm just like reading press releases or something, and then I look up the company on Twitter and there's literally zero. Sometimes there's some bots like here and there, but no one real actually talking about the company. So yeah, I think it's a great space to be in. And I mean, there are very few institutions that are as nimble as yours that can actually take advantage of the opportunity. And so yeah, it's definitely fascinating. And I guess you already talked on why you find this space attractive, this place attractive. But you also written in the past that investing is a subtractive, not additive process. And so, can you share any moment when focusing on less made you actually better?
Sure. So I'll start with the makeup of the portfolio.
Yeah.
Typically, Greystone owns between 10 and 12 companies. 12 might even be on the higher end.
Yeah.
But there are a few reasons for that. But the main reason is that I really like to focus, and I like to focus on the work within the work that I do. I like to focus on a select number of high quality businesses, and I like to focus on sort of the key drivers among those companies. And so I launched the firm by myself. I have a couple outsourced partners and occasionally utilize interns as well. But on the investment side, I'm the lead analyst and portfolio manager. And I think that structure has worked really well for me for a number of reasons. One, because I think investment decisions should be made independently. And two, because it just allows me to focus on the things that I think add the most value in the investment world. And, to each their own. People who build big firms have reasons for doing so as well, and certainly attract a lot of capital that way. But I've never been, I never set out to kind of be investable. I guess I can put that in quotes, or to attract the largest amount of capital. I think my goal has been to really preserve some of the favorable strategy elements that I have in place by investing as a one-man shop, by staying small, by capping the amount of assets that I bring in, and by investing in smaller companies. And the focus surrounding doing that has allowed me to structure my day in a way where I can spend most of my time on investment related work. So whether that's on the portfolio management side or looking for new ideas, the core competency, my micro competency, and the thing I love doing the most is the investment work. And so eliminating meetings and having to manage a team of people and going out on the road marketing and raising assets, although I would like to scale a little bit further, has really allowed me to just, again, focus on generating good results from my partners. And that's been kind of the mission from day one. And so when I talk about subtractive versus additive, I think that phrase kind of flows into everything that I do, whether it's how I structure my day, the portfolio that I manage. And then when I'm doing research on businesses, I think there is a point at which, I feel this way for everybody, but for me specifically, there's a point at which you reach enough, you've gathered enough information to make a decision. And you'll get to know a company much better during the course of your ownership and over a long period of time than you do at the outset. But we're all trying to, buy right, as they say. And so you do reach a point in your research process where you've got enough information to make a decision. And I think that distilling the information that you've gathered about a company and a management team and a future opportunity set, and sussing out the key KPIs there, the couple things that really matter with the business, and spending all of your time focused on those things and the drivers of them and how they are likely to change over time, and constantly looking for disconfirming evidence. That process is, again, subtractive to me as opposed to additive. And so, I used to think early on in my career, I used to think I had to know the name of the CEO's dog before I made the investment, and every little piece of information that came through was something important to pay attention to. And now I think with experience and better pattern recognition, I have a better sense of where I need to focus my time. And that process, again, is subtractive by eliminating the things that where you're gathering information and you realize aren't really going to move the needle in terms of the investment thesis and kind of the path forward. So, in addition, there are lifestyle components to this too. Like, on the focus side, like I wear kind of the same clothes every day. I, do have the same routine. I eat the same foods. I have the way I structure my day outside of the office is very similar every day. with exercise and again, eating healthy and getting enough sleep and that sort of thing. So I think focusing in that way where there's minimal distractions in my life and, my schedule, I try to, I have young kids, so it's not always possible, but I try to clear my schedule as much as possible for thinking and reading and taking my dog on walks and hanging out with the kids. And so there's a focus there and kind of a subtractive nature of things too, as well, where, having a packed schedule or a really busy month outside of work, sounds horrible to me most of the time. And so, that focus, and just, again, the simplicity of my life and doing just very few things, I think is, all bleeds into the job. And so, it's just kind of it's become kind of a lifestyle, I think, is just to keep things, to focus very deeply and to keep things very simple and kind of bare bones, if that answers your question.
Perfect. Yeah, I think you answered it perfectly. And um, I've been recently also trying to experiment myself with focusing on fewer and fewer things, even if like some opportunity comes up that seems like undeniably good and that you must take it. Sometimes actually the better decision is to stay focused on your path, and like as long as you're pursuing like the right things, I think focus is the key element to to kind of achieve any results whatsoever. So yeah, it's interesting that you frame it that way. I think you make it really simple to understand. So that's very good. And I also wanted to ask you, on the other hand, about your concentrated book. Obviously, you run 10 to 12 positions, which for most people is highly concentrated. Maybe there are some compounder bros or like other people that think like, oh, you have 3 positions in your portfolio and that's it. But yeah, for most people, that's extremely concentrated. And how do you stay comfortable when, say, a big position, assuming you have bigger positions than others, but a big position swings in the wrong direction, I would say, or like in the short term isn't doing as well. So how do you manage that emotionally? And then in practice, do you run a checklist to like check if there's anything wrong with the thesis, or like, yeah, guide us through that process.
Yeah. How do I manage it emotionally? Probably not well is the answer. No, the sort of core of my entire investment process is centered around getting to know the companies that we invest in really, really well. And, that helps guard against the emotional windfalls that take place during the course of the year as you see a stock become volatile over time. And whether it's a stock moving up significantly or drawing down significantly, knowing the company very well and understanding the business and how the unit economics work and how things flow into the financials, and then the competitive risks and threats there, I think is paramount to running a concentrated portfolio. This, I did mention that over time, you'll never have all the answers and you'll never have perfect information. We are secondary investors, so we're outside of the company. We don't know everything that's taking place within the business. We just do our best with the information that we gather and collect over time and try to make decisions using that information. So it's very much an imperfect science. And assuming there's different types of drawdowns, assuming that you can identify which type it is, whether that's a broad market drawdown is just dragging your businesses down with it, or it's company specific. I think the responses to each are different. If I have a large position and it draws down significantly due to broader macro fears or something's taking place market wide, whether it's a tariff announcement or fears of a recession or some other macro news, it's a little bit easier in that case to withstand a drawdown and potentially add to a position. As long as you identified those risks beforehand that don't think they will affect the business, that could be a good opportunity to add to your position. But if it's company specific, that's a very nuanced and different answer. And assuming you can identify what has happened, and you can sort of re-underwrite the business if it's a negative thing, there could also be an opportunity to add to your position there. But handling it emotionally has come kind of second nature to me as a result of just knowing the companies well. And over time, I find there's a correlation between the longer my ownership position is in something, especially a business that has worked very well and where management is good and they're executing it, that is a lot easier to stomach than like a new purchase, for example. So recently I have been adding to a position that I started buying a little while ago. It's becoming a larger and larger percentage of the portfolio. And I feel like I have a really good grasp on it. I'm kind of seeing the ball, so to speak, but it is a relatively newer position. We've only owned it in size for a few months. And so if that company were to if the stock were to draw down significantly, that might feel a little bit different from something that we've owned for 3 or 4 years. And so the response, I think, is very different between each type of company. But the, again, crux of it is really just getting to know the business very well over time. And prior to owning any investment, and even during the process, every company is rigorously stress tested by me. And so I try to come up with the worst case scenarios for what might happen to the business, either specifically or from a macro standpoint. And if I can, the best investments I've found pass those stress tests really well. And if I can sort of try to kill the business through those stress tests, and the company still comes out looking pretty good.
That's a very comprehensive answer, and I think you explained it in a really simple way. So yeah, I appreciate that. And I just wanted you to clarify a bit more what's this concept of re-underwriting, because I've had a lot of guests talk about re-underwriting, but then like obviously it's about like kind of reassessing the opportunity when a situation changes. But how does that look in practice? Like how can we build like a re-underwriting kind of process?
Yeah, it's a loaded question, I think, that has a lot of nuance, and it's definitely
Yeah.
dependent on the company. But I just went through this process with a position that had been a large holding for about 3 years. And unfortunately, I think I was wrong about the future trajectory of the business and maybe management and their credibility as well. And I spent I ended up reducing our position. I spent a lot of time deliberating about it and how to move forward from a portfolio management standpoint. And I know this business very well. I've been involved for, like I said, 3 years. I know management very well. I think I've uncovered all the nuance about this company and how its business works. And so I felt like I had a really good handle on the company itself, but unfortunately, the things that I projected were not materializing in terms of the unit economics translating to the financials. And as a result, I thought it made sense to trim the position and not hold it as a large stake. And so the re-underwriting process for that consisted of taking the new information that was coming in after years and quarter after quarter and incorporating it into my estimates of what I thought could happen and how that was layered into the time frame I thought on which it would happen. And so the conclusion that I came to was that if I am right about what I think will happen, X, Y, and Z should be taking place. And because X, Y, and Z is not taking place, I need to re-underwrite my assumptions and the timeline on which I think they can happen. And when I went through that process of looking at revenue growth and where I thought margins and cash flow could end up, I was very off in terms of what I initially thought versus reality. And the reality, unfortunately, in this case was negative. Not what I thought it was. And so I ran through a bunch of scenarios with the business about if things persist in the current state, what does that mean for 2026 and 27 and 28? And what does that mean for, again, revenue growth and margins and cash flow? And then what is this business worth given the fact that I think I'm wrong now and there's a new set of assumptions to use? And it turned out that the forward IRR and risk reward was much less favorable than I initially thought 3 years ago, and even, maybe 6 months ago. And so I think the re-underwriting process is really about layering in, taking new information that comes in, and then layering that into your current assumptions and just reworking your thoughts about the company and what the value of the business is. Because at the core of this is the value of a company is the future cash flows it spits out discounted back to the present over whatever time period you're using. And that is the anchor or the thing that we're hanging our hat on at all times. And so if there are other factors too, but if that changes in a material way based on new information or just based on a string of events that have not materialized in the way that I think they can, that involves going in and digging very deep into, again, your assumptions and kind of re-underwriting what you think might happen. And so in the case of a large position, that process is a little more extensive than it would be if it was maybe a smaller position or where I'd like to see things play. I'd like to give it a little more time to play out. But I think, again, I like to look at our companies on a 3 to 5 year timeline, and I like to let management do their thing and let the business execute and let things play out over time. And I'm even willing to be patient beyond that period. But at this point, I realized that I think I realized that I was wrong, and re-underwriting the business and re-examining my assumptions meant that the future value of the company was lower than I originally thought, and that the sort of visibility that I thought I had into positive results was no longer there. And so when you lose that, both in a concentrated portfolio, large positions are for companies where you have very high degree of certainty that things are going to work out and your downside is very well protected. When you lose that, a lot of times, for me at least, a company is not no longer warrants a large position size. And so in this case, I kind of not only lost confidence in management a little bit in the business, and there were some credibility issues there, but the visibility and durability of the investment thesis started to kind of whittle away a little bit. And so it just doesn't make sense to hold it as a large position where my degree of confidence or certainty is very high. And so I really reserve those, let's say, top 5 positions that are much higher weightings for businesses that are incredibly durable and resilient, and where there's multiple levers to make money, and where management is excellent, and where the future path, where I can say 3 to 5 years from now, is this company going to be doing more of X? Are they going to be selling more of X? Are their earnings going to be higher than they are today? What is the visibility I have on that? And what is the probability that I'm wrong? And the top 5 positions are for companies where the degree of confidence or certainty is quite high. We never know. It's never 100% certain. And so in this case, it didn't really fit the bill. And going through that process of re-underwriting my assumptions was eye-opening. And very necessary. So that's really what it involves. And you can re-underwrite a business in a positive way and a negative way. In this case, it was negative. I've certainly had positive ones as well, but that's kind of what it involves from front to back, if that makes sense.
Yeah, makes perfect sense, Adam. And another concept I wanted to unpack is the concept of primary research, because that also is a loaded word, I guess, or a loaded concept. So maybe if you could break down what primary research means for you and your process, it would be really useful as well.
A large part of what I do is focused around centered around primary research. And I think it's very easy to get a really good grasp of a business by reading publicly available information, whether that's the filings, conference call transcripts, or whatever else. And you can probably get 15 to 20% of the way there just through those documents and, again, what's publicly available. But I would say today, maybe 80, 90% of what I do is primary research related, where that's looking outside of what's publicly available and trying to determine what reality is and how things will unfold moving forward. And what I mean by that is I just want to get a really good sense. The best way to get to know a business, in my view, is talking to people who really understand the business and the industry. And so what I'm trying to do is get a really good handle on both of those things. And I don't want it to just be coming from my experience or my pattern recognition or what I've gathered through publicly available information or my current knowledge base. I really want to kind of work to expand that and to get a really good understanding of how a company competes with other businesses, what the industry looks like, how it's changed over time, who the leaders are in the industry, and how they have gotten to be that way. What is the true picture of margins here, and what makes sense in terms of the unit economics, relative to what the company is saying or what they're trying to do? How is their strategy? How likely is their strategy going to unfold? How likely is it that their strategy will be successful moving forward? And I really just want to get a better sense. I want to get all those questions answered, and I want to get a better sense for the business and the industry. So I spend a lot of time talking to people and a lot of time reading about, again, industry history and publications and anything I can get my hands on that will help me better understand how things are evolving over time. And the idea here is just to identify, again, the competitive threats and the risks and the sort of adverse business outcomes. If a company is projecting that they can grow 10% a year for the next 5 years, and I go talk to 5 to 7 people in the industry, and they all tell me that that number is way too high or way too low, that's a very interesting data point to me. Like if there are specific reasons why I think the company's maybe being too aggressive or not aggressive enough, that's interesting. That just provides more information for me to dig into and helps further my understanding of a business or an industry. And like, I'll give you just a high level example. We own a business that provides life safety and fire safety services to commercial building owners, and they do some other things as well. The company's called API Group. And I thought the opportunity was tremendous when I came across it 5 years ago. But I didn't know much at all about the industry or the business. And as a result, I went out and I spent a lot of time talking to commercial building owners and to insurance people, and I went to a lot of fire departments as well. And I just tried to get a handle on everything that had to do with installing, servicing, maintaining a fire safety system within a building. And that obviously increased my knowledge base, but it also opened up a significant amount of questions that I had about how other companies, it helped answer a significant amount of questions I had about how other companies in the industry compete and where value is derived and why API's strategy is effective relative to other people. And so I don't think I could have gotten that understanding just by reading the 10K or talking to management or doing the sort of work that, maybe is like more easily available. And I think, primary research is a big differentiator for Greystone. I spend a lot of time doing it, and I think it provides, again, an opportunity to really go deep on our companies and to learn a lot about each business and to get a much better understanding of how things might unfold moving forward than if we were not doing that work. So it's become a larger and larger part of my process over time. And honestly, it's, reading 10Ks is boring. They're at the heart of it. It's a legal document and it's very dry, and I enjoy it because this is what I do. But talking to people and getting to know what's really happening in a business or an industry, that's the fun part to me. And it's something I really enjoy. It's hard work because it's difficult to source the right people and it's time consuming and takes a lot of effort. But again, I think that's a kind of a differentiator for us and something I'll never stop doing. So it plays a pretty crucial role right now and has helped me, I think, uncover some pretty good opportunities.
Nice. And actually, you touched on a point that I really wanted to ask you on. And I don't want you to disclose your secret sauce or anything like that. But how do you source these conversations, or how do you source these people? I guess part of it is just, as you mentioned, like going to commercial buildings and trying to ask questions. But uh, it's for someone like myself. I've tried to do this, and maybe remotely is harder. Maybe being on the place is it's easier. But how do you get people to talk to you, and especially qualified people? Because maybe it's easy to talk with an employee, but like mid-level manager of a competitive business or a competitor business, something like that might be harder. So yeah, guide us through your process if you have one, or if it's just like an art, and you can just give us some brief overviews on that.
Yeah, I don't know if I have any secret sauce, but there's a process I go through with each business. I'll take a step back. So technology
Yeah.
has again made it easier and leveled the playing field in a lot of ways. I think you no longer have to rely. I don't have the budget for very expensive expert networks. I do subscribe to some of the more popular ones, but having somebody paying someone $500 an hour or what $25,000 a year to source experts for me is not in the budget currently, and so I have to be resourceful and creative. And again, I don't think there's any secret sauce, but technology has really leveled the playing field in this area, whether it's Google or now ChatGPT is incredibly helpful. Or LinkedIn, I think has been the hit rate on LinkedIn is very low, but occasionally it's helpful.
Hmm.
So you can kind of source your own experts by piecemealing some of these pieces of technology together and come up with a nice list of people to go after. But one of the things that I've found that has been really helpful to me is using private businesses to do due diligence public companies. And I think this is also
Mm.
a bit of a differentiator for us, which is whenever I find a business that is doing something in public markets, I will I will try to find, whether it's Google or some other avenue, very similar businesses or adjacent businesses that are private within my area and within driving distance. And I will just I will reach out and I'll get in the car and I'll just go visit these people and I'll ask them to talk to me about their businesses and the industry. And I think the hit rate for that is much higher than a LinkedIn or trying to reach out to like an employee or former employee. It's much higher than it's much better than using an expert network sometimes, because the expert networks, unless you're sourcing your own experts, they obviously just provide people for you who can be helpful, but again, they're not the people that you kind of source yourself. And so I found that to be very helpful because I can learn a lot that way, and people in those positions have often been very willing to talk about their businesses. Like somebody may be very interested in taking 30 to 60 minutes out of their day to explain to me how their industry works and how electronic components are manufactured, for example. And I just offer, I don't really have anything to offer, but I just offer research and whatever efforts I'm doing. I just try to explain to them that I'm an investor and I'm doing some research on this business and this industry. And I would love to chat with you, and anything that comes from my work, I can share with you, and so on and so forth. And that message has been pretty well received so far. Excuse me. And so I've spent a lot of time doing that lately. I think that's become a bigger and bigger part of my process. And so it's really, there's no formula for it, but it's really just trying to piece together as many experts as I can, and then supplementing that with the actual expert call networks, which are helpful as well. So it's a combination of both, but I would say it's how I source them and get them to talk to me is just case by case specific, and it's very kind of manual, labor intensive.
That's super interesting because I literally never thought about this. And I was just thinking I'm so stupid because, like, for example, I was trying to get like um I was researching a security business in Australia. and I was trying to get Australian people that worked in the industry in Australia to talk to me. But if you really think about it, like the security business, like CCTV monitoring and all of that, isn't that different in Australia or in Portugal. It's pretty similar. The economics must be kind of similar. The businesses or the brands that actually operate these things are mostly the same, and so it makes no sense to kind of overcomplicate. And yeah, I think that's something I'll definitely apply in my process going forward. And maybe I could have learned and built connections with people that are also in my country. I live in Portugal, and my city, that might be actually interesting for other businesses I might research in the future. So yeah, thank you. I will definitely steal that idea from you, and thank you for sharing that. Now, going into another topic or like theme that I think has become pretty popular on Twitter and social media is the concept of turning rocks, right? And essentially, turning rocks is just looking for ideas, screening manually, going A through Z. And so, can you guide us through how do you do that, whether you do it or not, or like what's your favorite source of manually screening ideas, and what are you looking for when doing this?
So I feel a couple ways about this. I think it's really important to turn over a lot of rocks in some areas, and in others, I think using your experience and pattern recognition to uncover what you know well and like is also really important. And that may involve turning over fewer rocks. Early on in my career, I think it was incredibly beneficial to look at as many ideas as possible and to try to develop a base level understanding of what makes a good business and how value is driven over time. And looking at, I'm a generalist to this day. And so looking at a number of different ideas in a number of different sectors or industries is very beneficial. Today, my focus has become a little bit narrower, and I really have a much better idea of what I'm looking for and what kind of stands out to me and what I would like to put in the portfolio. And so it's less about, so I spend a lot of time saying no to a lot of things and ignoring a lot of areas in public markets. That allows me to focus and what I would say sort of deepen my circle of competence as opposed to widen it. And I'm always open to learning new things and trying to widen my circle of competence. But now I have a much better understanding of what makes sense for me in terms of the type of opportunity. And so it's more about trying to find more of that than sort of new ideas. And for also for what I'm doing, I really like to own our companies for long periods of time, and having a position that's been in the portfolio for a length of time and that maybe is a larger position, excuse me, that's kind of earned its way there. And so any new idea that replaces that idea there's a very high hurdle rate to replace what's in the portfolio right now. And so most companies just don't meet that hurdle rate. And there's a lot of factors there, which we can discuss, but that means that I'm more interested in getting to know the companies that I do own even better and finding kind of similar businesses or opportunities than I am just looking at new ideas. And I also think that the benefits of random stock research, just screening for something, or, A to Z, reading 10Ks from A to Z in a certain market cap spectrum, the return on that time is fairly low for me now, and maybe for others in general, because there's a real benefit to cumulative knowledge, whether it's an industry or a type of company or a certain setup, and trying to find more of what you like and are good at and what has worked well. Well, for me, I guess, is really much more important than, again, just finding the next new ticker, so to speak. And so most of my efforts are focused around either getting to know our companies even better by studying their competitors or more of the industry, or digesting more information around, the competitive threats, and also just trying to screen for things that I think are interesting. And that can come from on the management side. Like a good place to start for me when looking at a company is the management team, the CEO, their background, what they've accomplished in the past, why they're running this business, what their incentive package looks like. And then there's also just the qualitative aspects of a company, the value prop to the product or service, how entrenched they are with their customer base. And there's a number of other things that I think take place outside of like a quantitative screen that I really pay attention to. And so I probably do what most people do on a monthly basis in terms of like have a system for new ideas to look at. And I've got sitting right next to me right now, I've got a pipeline of things that I'd like to get through. That were flagged to me for whatever, for various reasons. But most of the time, I think I have a very good idea of what I'm looking for and try to just focus on that. And outside of that, occasionally I'll study a new industry or a new space that I haven't spent a lot of time on. Like I spent a ton of time on energy in 2024, and that was very new for me. And obviously still learning, et cetera, but that uncovered a really interesting investment opportunity for me. And that was just the result of curiosity and trying to learn something new. And so not going to pretend like I'm an expert or anything, but it's going to be an ongoing process to learn more and more about the energy industry and various aspects of it. And I think my experience in pattern recognition is better now than it was a year ago. But, and so, yeah, it's just kind of an ongoing process of learning and uncovering what has worked well and what I like and what I want to put in the portfolio. And then just trying to find ideas in that realm and kind of layer that idea or philosophy with the actual idea generation.
Mm. One thing I find hard in investing is to actually prioritize what's most urgent. Obviously, if one of your portfolio companies is reporting earnings, maybe it's easier because that day you just focus on that and trying to impact that. But there's infinite amounts of work you can do on your companies or companies that aren't in your portfolio. So how do you prioritize and organize your workflow so it doesn't become a big mess? And then you like, how do you make sure you actually when you start doing something you go through it and it's the right thing to do at that moment?
I think a lot of that process comes naturally to me. I'm an organized person by nature, and the way my brain is able to compartmentalize things makes it a little bit easier for me. It kind of it comes without too much effort. But that a big part of that process is done kind of before buying an investment and tracking. I lay out certain KPIs that I want to track and things that I'd like to follow with a business. And then I think just over time, you get better at understanding how a company communicates with investors, how management talks, the cadence of their reporting, what they present versus what they don't present, or what they disclose versus what they don't disclose, and how that changes over time. And so um, a lot of that work is done beforehand, but it takes time to really get familiar with the business. And so the bulk of that work is really just tracking the KPIs that I think are going to drive the investment thesis. And then just, again, like you said, absorbing incremental information and trying to layer that into the work that I've already done. And so it's really just a process of kind of like constant incremental progress and time. And there are things that come up when I'm researching a company that I'd like to know more about, and maybe a risk that I haven't fully mitigated. And any like ongoing portfolio management work is really centered around that. And so it's kind of broken down for me just on a weekly, daily basis. And I just have at a very high or simple level, just tasks that I want to complete, re- uh, measured against, or sorry, relative to the companies that we own, and kind of, again, what information I'm seeking. And so some days or some weeks, it's nothing. Like there's a few companies that, where I haven't done, kind of maintenance due diligence work on in a little while. I think things are trending in the right direction, and there's a few things to check here and there, but nothing too thorough. And then there's others that, I've spent a decent amount of time on and want to make sure things are trending in the right direction, and would like to talk to an expert in the industry about this or that thing. So I know I'm speaking somewhat vaguely here, but it's really just a process of kind of taking in incremental information and then time and seeing how things unfold and how the company executes.
Got it. Yeah, that's really perfect. And I think a lot of people kind of know you for the microcap club business breakdowns. At least I watch most of them, and I really enjoy them. So I just wanted to ask you, what have you learned from that experience so far? And like, is there anything you can talk when it comes to asking good questions and kind of yeah, just managing the art of conversation?
I think you're doing a great job on this interview. You asked really good questions, and it's clear, spent a lot of time up front thinking about how the conversation will go. I can tell this feels much more like a conversation than an interview. So I certainly, maybe you should be giving me advice. But no, I've really enjoyed doing that. I think I'm glad that I'm kind of hosting those interviews, because not only does it give me a chance to kind of hone my question asking skills, but also to get in front of really interesting companies and just learn more about the businesses. And
Mhm.
so it's been really fun just going through that effort and getting to know more management teams. And each one is different, and the way they communicate is different. And the businesses are different, and each has their own style. And so that's been fun to kind of layer into my research process. And I think honestly has helped build my pattern recognition a little bit when I can, I spend some time before the interviews looking at these companies and, reading the calls and getting a sense of like how they've been executing lately. And you can tell if things are going well versus not so well versus maybe haven't inflected yet. You can tell how that drives the tone of the interview, which I think is very interesting, and kind of connecting those dots has been fun for me. And especially if things are going well with a business and the interview it goes really well, I'd like to spend more time on that company. Kits Eye Care is a really good example of that. I'm almost positive I owned it when I did that interview with their COO, but that was one of my favorite interviews, and I learned a lot. And so I've really enjoyed that process. But on the question asking side, I spend time preparing. I think that's the key. I certainly don't have all the answers, but asking good questions. I'm a naturally curious person by nature. I think that's partly why I can do this job well. But asking questions has always just been a very natural thing to me. I'm genuinely more interested in other people than myself, or what other people have to say than what I have to say. Uh, Even though I've been doing most of the talking on this interview, which I don't always like, I'm more interested in you and what you have going on. And it's very easy for me to find really good questions to ask because I'm a curious person. And I just like to sort of, um, I guess, ping pong off of how the conversation is going. And if management says something interesting, I jot it down. Or if they bring up a point that I want to dig into further, I'll jot it down. And so that's really what drives the question asking in those interviews. And with my management teams, like I have a set of things that I'd like to uncover in a management interview. But as management talks, they say things that aren't directly related to my questions. And again, that uncover new questions for me. And so it's really just about sort of, again, ping ponging back and forth and getting a little volley going about, as the conversation unfolds. And so it's part hard work and part kind of comes natural to me, but the preparation work, I think in that sense really helps a lot. And I have an idea of what I want to get at with the business and what I think is important before we start. And so that helps kind of shape the direction of the conversation. But it's also an art. It's also an art, that you get better with over time. And I've watched a number of your interviews that have been very good. You've had some much better guests than me, and I've really enjoyed how you've kind of done that ping ponging and made it feel much more like a conversation. And I've really enjoyed a lot of your shows. So as you get better over time, and so it's just a matter, like a lot of things in this business, it's a matter of just repetition and time.
Yeah, yeah, for sure. And thank you for the nice compliments. I think it's always nice to chat with other people that kind of do these conversations or record these interviews, because it's very different from a in-person conversation where you can actually see the full body of every detail counts, I think. So yeah, it's much harder to do it remote. And yeah, I think you do a great job, and hopefully I'm doing a good job as well. And I'm happy that you say that. um yeah, so moving on with my next question, which is actually on how do you differentiate between like an optically expensive company, so it's actually cheap, from a value trap or a risky investment? Because sometimes, at least in my experience, the best opportunities come when something isn't exactly screenable right away with software or anything like that. So maybe you can expand a bit on that and unpack this concept.
Sure. I have a couple thoughts on this, and my views about this question have changed. My views on this have changed a lot over time. I think the day one portfolio for Greystone was made up of statistically cheap microcaps, and it was much more of a value based. Am I getting a discount to the assets, the cash flows, but maybe the quality of the businesses wasn't so high. Today, the portfolio has shifted much more toward the quality spectrum. And I also want a value price, but the businesses in the portfolio are much better today. And what I mean by that is their unit economics are better and the opportunities for value creation and growth and earning high returns on capital are much better than maybe a few years ago or early on in my career. And that's a big differentiator. I think when you ask how to differentiate between a value trap and a good business, that's a big part of it, is just the future growth opportunities and what happens with margins and the opportunities to reinvest an incremental dollar of capital and at what rate of return can you generate, are you going to generate on that incremental reinvestment. And so there's a lot surrounding that that can help you separate a value trap from something else. But what I really like, I'm kind of agnostic toward, I'm labeled as a small cap and micro cap investor, but I'm really an investor. My goal is to make money and to do it in a very efficient, tax efficient, and and sustainable way over a long period of time. And so I consider myself market cap agnostic and company agnostic, and I'm really just looking for the best opportunities. I have criteria that I want to hit on, but my search for good investments doesn't start with the market cap anymore, and it doesn't start with the type of business anymore. And so I'm just much more maybe open-minded these days, but still knowing what I'm looking for. And as a result of that, the mandate is fairly open. I can invest anywhere, and if something fits my criteria, I don't care if it's trading at 20 times earnings or 2 times earnings. I don't care if it's in the US or not in the US, outside of the US. I don't care if it's a $37 billion market cap or a $37 million market cap. If it's something that I think makes sense for me to look at, or the portfolio, it fits my criteria, I will look at it. So in that vein, I'm very open to the types of opportunities. Like, I'm not just looking for cheap stocks quantitatively. I'm not just looking for good businesses and I'll pay any price for them. But I think most of the market now has moved toward a quality and growth sort of framework where people are much more willing to pay higher prices for businesses that are very good. And there's nothing wrong with that approach. It has worked very well over the last decade plus. And some of the best businesses in the world are also some of the largest businesses in the world. I agree with the quality part of that thesis, but for many of these companies, and especially today, I just can't get there on price. And there's a lot of companies that are trading at valuations that weighed against their growth prospects and their future cash flows doesn't make sense for me in terms of how to earn the type of return that I want to earn. And so what that's done is that's left a hole in other areas of the market where I can find really good companies that are trading at really cheap prices that are maybe, to your point, misperceived as something that they aren't, either on the quantitative side or qualitative side. And when I find those opportunities, a lot of times they may work out very well just on the cash flows of the business or the positive capital allocation from the management team. And you're purchasing them at such a price where you can do very, very well, even if multiple expansion doesn't happen, or if the market doesn't come to realize that the business is actually a higher quality than what's being perceived. And so I spend a lot of my time looking for those companies that you mentioned that maybe are not screenable, or if you pull up their financials, they just look ugly, but underneath is something really significant, or the unit economics are excellent, or something is obscuring the consolidated financials. That's a very interesting place to start for me in terms of looking at ideas. And so, yeah, I spend a lot of time looking at those things. And when I get that far, I, like you or anybody else, I really want to make sure that I'm not getting involved in a value trap as well. I don't like declining businesses. I don't like industries that are horrific, but I'm just investing in the best company in a terrible industry. I really try to avoid melting ice cubes, and where companies don't have any opportunities for growth whatsoever, and there's no kind of additional levers to do well over time. over time outside of multiple expansion, that's not always attractive to me. So, um, what I'm looking for comes in many shapes and forms, but I've really put an emphasis on kind of avoiding value traps and lower quality businesses as compared to maybe the last, maybe 5 or 10 years ago.
Yeah, I think that's extremely interesting, and I wanted to, because you talked about your criteria and being agnostic um, within that, which resonates a lot with me because I have, yeah, like you said, multiple billion-dollar market caps in the portfolio, and then like $20 million dollar market caps as well. So I wanted to ask you on the hurdle rate, or like your, yeah, the intended amount that you want to compound that every year for making it simpler for people. How closely does that track with your actual results?
What I'm looking for at a high level is when I invest in a business, I want to reasonably understand if the company can double within a 3-year period, which equates to 25, 26% return per year. And you could say that returns since inception have tracked that, largely tracked that idea, but my
Hmm.
portfolio management has gotten in the way in a number of areas, and our returns could be a lot better. We've had some really significant winners and have not, I think, generated the returns on those that I would have liked. And so, done a lot of tweaking and soul searching around my portfolio management. And I think things will be much better moving forward. But yeah, our results have largely tracked that. And I'm looking for, conservatively speaking, I'm looking for companies that can double within 3 years, and I'm trying to do that without multiple expansion.
Hmm. Got it. Yeah, yeah. That's really helpful. And I also wanted to talk about the art of trimming and averaging up, because usually it's black or white, right? Either you sell or you buy, and most people just talk about it. But from my personal experience as well, like there's much more nuance when it comes to selling and buying, and it's more about like trimming when things aren't in your comfort zone when it comes to price, or maybe just the future outlook of the business. And so I wanted to unpack those like teachings that you learned along the way, because you mentioned like the portfolio management side of things maybe wasn't optimal to capture all the returns, right?
I have pretty firm rules around position sizing and adding and trimming, et cetera, and try to stick within those rules during the course of ownership. It's very much an art, more art than science, and portfolio management is where the rubber meets the road in our business. If you have a 1%
Hmm.
position that 5x's in 2 years versus a 20% position that does the same, your results will look incredibly different. And so I have rules surrounding position sizing and trimming and adding, but generally speaking, I don't like to sell stocks, and what doing so, I'm usually forced into it, whether a company has significantly exceeded my valuation target initially, or what I think is a fair intrinsic value, or I've made a mistake on the business, whether in terms of my assumptions or just on the management team or the people running it, or they end up doing something sort of out of the blue that I didn't expect, or there's some
Hmm.
competitive threat that I missed. Those are generally the reasons why I sell a stock. Otherwise, I'm more apt to kind of hold on to things and try to let the business compound if I think there's a reasonable return profile to be had. And on the adding side, yeah, on the adding to a position side, I really like to do it. There's an occasion where I can average down into something like we talked about earlier, but I really like to add on momentum and positive execution. So if things are working well and the thesis is tracking in line with my expectations, or even the stock is going up, I don't mind averaging up into a higher price, or on the back of really strong execution. What I'm really looking for in any scenario is risk being taken off the table. And that's a good sign to add to the position. So I will typically hover around, 5 to 7%, something like that. And then as things work and as management executes and as I become more familiar with the business, I will average up over time, even if it's at a higher stock price. And that has largely served me well. Number one, because there's kind of a momentum factor there. Not that I invest in a moment. I don't have a momentum strategy, but I think when things are working well, that's a good time to add to the position. And as the business executes and as the fundamentals are inflecting or improving, that's also a really good time. So I generally try to stick within those confines, and there are exceptions, obviously, but it's rare to enter into a very large position at cost immediately. There are exceptions, obviously, but I like to kind of let the positions grow into larger ones, and then I'm fine with holding them or letting the business continue to do their thing. But that's generally kind of how the framework that I follow, and it's really just all centered around business performance.
Got it. But can you share sort of those practical mistakes or like lessons from the past that can exemplify like these rules that you have? Because obviously you came up with these from experience, I guess.
Yeah, yeah. I mean, I've just been on the biggest mistakes that I've made have been selling a good company too early and not owning enough of a good company. And so both ends of the spectrum there are why I say our returns could be a lot better. And the best way to kind of express that is I found a really good investment a few years ago that I thought was worth significantly more than the price I paid. And when the investment started to work well, we made some money. I sold it because I had some intrinsic value band or range in mind about what the company was worth, but it turns out that they were in the very early stages of what they were doing, and the stock went on to return multiples of the company's value over the course of the next couple of years. Would have been one of my most successful investments, and that caused me to tweak a lot of rules around position sizing and re-underwriting the business and add into positive execution. And so there was a really big winner that I missed out on because I had some kind of arbitrary rules around both position sizing and intrinsic value. And so that's changed a bit. And then there's been other positions where I still own, maybe from a few years ago, but the businesses have done much better than I expected, and I didn't own enough of them. Like I was maybe in that 4 to 7% band and waiting for positive execution and wanting to sort of add. And then the stock maybe ran away from me a little bit, not based on anything really. And I continued to follow the business. And then quarter after quarter, good results flew through, and I maybe just kind of sat on my hands. And then the stock went on to do very, very well, and the business went on to do very well, and I did nothing. So trying to avoid those mistakes again and eliminate more of those where when I know I have a good situation, try to just manage the position a lot better and understand that I'm not going to add to our position at the exact point I like and at the exact sort of bottom initially or even over time, and that I may have to buy stock at a higher price, but then to not anchor to that valuation is really important skill, I think, that I've tried to work really hard on avoiding over the years. And so those are the primary, on two ends of the spectrum. That's kind of why I say our returns could have been better. And I think I'm just trying to improve upon that skill set, if that makes sense.
And how do you avoid like overcorrecting? Because sometimes prices do get ahead of the intrinsic value and by a wide margin, and that might actually be a risk going forward for the investment in itself. So how do you kind of account for that and make sure that now you're not overcorrecting on the other end of the spectrum?
Sure. So the answer is that I will try to dedicate my investing life and career to avoiding these mistakes, but unfortunately, I don't think I'll ever get it 100% right. There will always be
Yeah.
times when I don't own enough of something that works very well, and there will always be times when I sell something too early. That's just the nature of what we're doing. And
Yeah.
as much as I would like to try to avoid that, I think it might be an inescapable part of my career. And so I still have the rules and position sizing framework in place, portfolio management framework in place. I don't think the rules are meant to be thrown away, but being a little bit more aggressive when the opportunity calls for it is very helpful. And being a little bit more patient when the opportunity calls for it is very helpful as well. But thinking that I'll catch, an Amazon in the .com crash at $4 a share and still hold on to it today is kind of silly. There are very few people on this planet who would I think, do something like that. And so that's an extreme example, but it'll be a difficult thing to try to avoid. But again, something that I think a lifelong set of learning will try to mitigate and the damage of over time, if that makes sense.
Yeah, yeah, and yeah, I totally feel you. I just wanted to kind of dig deeper on this topic because I feel like sometimes we might be great stock pickers, but not great portfolio managers, and so I think it's more about minimizing our damage to the returns rather than really, yeah, maximizing every single bit, because it's impossible. Like, every single case is so specific, and maybe sometimes you can take the wrong lessons from things, and yeah, it's really not a linear kind of learning process. So yeah, I
I'm
totally
very
understand.
sure. I'm very cognizant of trying to avoid learning the wrong lessons. And
Yeah,
it's a very difficult process, but the general idea is the sort of popular aphorism, how much do you lose when you're wrong and how much do you make when you're right? And you want to make sure
yeah.
that ratio is skewed in the right direction.
Exactly. Yeah, for sure. 100% agree. And so an analogy that I think was really interesting that you made in the past is that evaluating management teams is like evaluating talent in sports. So maybe the NBA or something like that. So what's a leadership quality or something you look for when evaluating this talent early on?
I really like to see skin in the game. That's a huge signal to me. And it, I think, changes the scope of a management team's decision making. If somebody owns a lot of equity relative to their compensation and they have a lot on the line, if things do not go well, that's very important to me. I know not every investment in the portfolio fits that bill, and there's other ways that managers can be incentivized. But generally speaking, that's really important, which to me is the equivalent to kind of putting yourself first as a leader and a manager. If things don't work out well with the business, they're not going to work out well for you first as a large owner. And I like to see management teams who buy stock in the open market and add to their stakes over time and that sort of thing. Um, there's a business I saw 2 days ago where the management team, it was a spinoff, and the management team, the CEO bought, I think, $50 million of stock in the open market a few months after the company was spun off, which I think is the largest insider purchase I've ever seen. I don't want to give away the company right now because I'm still looking at it, but that's a huge signal to me, and that that I think incentivizes the CEO in a major way. So that's probably where I start. Obviously, I'd love to see things like character and a good person and understanding how to operate a culture and a smart operator who knows how to allocate capital and those kinds of things. But in the sports world, it was very easy to identify who has skin in the game and who really cared about the outcome for the team versus themselves and their career and their next job and how much money they were getting paid. That was true on both the player side and the coaching side. And so I tend to lead with that. And as long as that is the case, I think that they're building relationships with managers that have a lot of skin in the game is always very fun because they think about their companies through a much different lens. And they have the ability to think long term and think independently and do things maybe that the the market doesn't like up front if it's the best thing to do for the business. And kind of
Yeah,
sussing out those signals, I think, is really important to me. And I also pay attention to track record. So experience operating and a history of really good decision making and capital allocation is really important to me as well. I think people and companies are very unlikely to radically shift how they think about creating value like overnight. And so a history of doing things the right way is really good. Family led businesses a lot of times have that. They also actually have the opposite of that too, unfortunately, but it can go both ways. And so between those two things, the skin in the game, three things: character and a track record of really good decision making and a history there. I think those are the most important aspects that I kind of lead with when looking at management and maybe comparing them to sports.
got it. Yeah, I think that's perfectly said. And I always love the analogies with sports because it's such an extreme environment, right? Like on the performance side, and like on how they are trying to really spot these young talents. And in any sport that's competitive, you'll get that, and you can derive some lessons from there. So yeah, I love those. Maybe to bring this home, can you walk us through a current idea or a past idea, just a case study that's really practical, that kind of wraps up all your investment philosophy and knowledge in a practical use case for me and my listeners to, yeah, just get a better sense of everything?
Yeah, I'll give a sort of high level overview of one company. I don't love to kind of pitch stocks on these podcasts just because I don't want it to be construed as investment advice. And there's now 20 quarters of letters on my website that outline in detail a lot of positions. And I would welcome your listeners to kind of read through that as well to get my thoughts on some of the companies. But there's a business that we own called Kits Eye Care, and they're an e-commerce retailer of contacts and glasses. And that's a business that I'm really optimistic about and think that the future growth runway and potential return profile is really going to be really good. And that was a business where my search for that company kind of started with the management team. The chairman founded and ran a very similar business in the early 2000s that sold contacts and glasses online, probably before the market was ready for something like that. And he ended up selling it to EssilorLuxottica for around $450 million. And he sort of, after his non-compete expired, he kind of came back to do a similar but better concept. And Kits is really interesting because, for a number of reasons, but because their business model is vertically integrated. So they manufacture all of their glasses in-house and their lenses and frames, and they source their contacts cheaply from third parties. On the glasses side, this allows them the cost savings from owning your manufacturing allows them to pass those cost savings on to their customers. And as a result, their price point for their glasses is lower than any other e-commerce eye care retailer relative to the quality that you get. So their vertical integration has allowed them to be sort of the low-cost provider of quality eyeglasses. And that model means that they can do so profitably. So every pair of glasses that they sell, because it's manufactured by them, comes at significantly higher gross margins than on the contact side and from most of their competitors. And as a result, the unit economics of the business are excellent. And the eye care category is shifting online in a huge way, especially post-COVID. So there's a significant amount of tailwinds at their back, where I think pre-COVID, something like 20% of contacts were sold online, and today it's closer to 40. And pre-COVID, I think around 8% of glasses were sold online, and now it's closer to 20%. And that growth is, again, shifting rapidly from the brick and mortar space. And the value prop that Kits offers to their customers is incredible. And I've really come to appreciate it both as a customer and in talking to people about the company, where you can get, again, a very high quality pair of eyeglasses and frames for under $50 with some lens upgrades. Without upgrades, you can get a pair of prescription lenses and frames for $28, $30. And that value prop is really interesting because not only does it keep people coming back to the site, I found that most people own more than one pair of eyeglasses, but they also started the company selling contacts to customers instead of glasses. And so that's created, for people who wear contacts, it's a recurring revenue stream for them. And that's created a nice recurring revenue base into which they can sell their eyeglasses. And so I think 70% of their revenue is recurring today, and they have a nice base of customers that they can kind of cross-sell their eyeglasses to. And each cohort, they've been public since 2018. Sorry, they were founded in 2018. They've been public since 2021. And each cohort on a yearly basis of customers has come in at higher and higher LTVs and lower cost of acquisitions. And so it's a really interesting model that I described in much more detail in a couple letters that I've written. And there's some things on my blog as well that your listeners can read. But it's a really interesting model that I think has a very big right to win in the category moving forward. And over time, Kits has the ability to grow 25, 30% top line into the foreseeable future. And over time, as the percentage of glasses that they sell increases, that will cause their margins and cash flow to inflect pretty significantly. And then the next 3 to 5 years, relative to their market cap today, they could be generating a significant amount of their market cap in cash. And the insiders here, the CEO, the chairman, the COO, they're all significantly incentivized. They own about 70% of the business. They, again, have a significantly long history of operating and capital allocation. So very happy to be invested alongside them. I think they've been executing tremendously well. And in my view, Kits is kind of a better mousetrap for e-commerce eye care retail, and is one of the only businesses that is doing it pure play online and offering the quality that they offer. So in my view, the future is bright, and I'm really optimistic about that business. And I think I'm seeing the ball on this one.
Nice. Yeah, that's perfect. I think that's a great way to wrap up. And if I had asked this question earlier, I would load you with questions. But I think people can also go to your letters and kind of see your expanded thoughts on this. It's just like a snippet of what the whole thesis and yeah, the company does, I guess. So yeah, I really invite people to check out Greystone's website and read your letters if they are interested. And yeah, just wanted to really thank you for this 1 hour and a half that you dedicated to my audience and I.